Hello and welcome. Apologies, I've got a bit of a frog in my throat this morning. So welcome to Hugessen's 2021 Proxy Season Review webinar. For those of you who don't know me, I'm Michelle Tan, a partner with Hugessen Consulting here in the Toronto office, and I'm going to be moderating today's session. I'm delighted to say we have almost 300 registrations signed up for today, and I know we've got some sort of last-minute stragglers coming in as they register. They sign up looking for those numbers. We are recording this webinar, so we're going to get started right away. This is the first of two webinars that we're hosting this month, and if you haven't already signed up for our ESG Diversity, Equity, and Inclusion session on June 29th, you can do so on our website. Today, our audience does include a mix of management, directors, and shareholders, and we've got a great lineup of content and insights to share with you. Quickly, joining me today are Kevin Zhu, an associate in our Toronto office, John Skinner, also a manager in our Toronto office, Blair Jones, a managing director with Semler Proxy, our affiliate partner in the US, who's joining us from New York. So welcome, panelists. To navigate the next hour, we have divided it into three segments. We're going to have each of our panelists do a short little presentation and then open it up to questions after that. First up, Kevin's going to present the findings from our annual TSX 60 proxy season review, which we've just completed. And then in our second segment, John's going to dig more deeply into the key impacts in COVID-19 on incentive plan outcomes for 2020 and some other emerging trends. Our third segment is going to include an overview of the US pay trends from Blair. And we've left lots of time at the end of the hour to bring all of our panelists back together to answer your questions. Before we get started, though, a couple of quick housekeeping items. We have left all participants in listen-only mode, but you can submit your questions through the live event Q&A feature on the right-hand side of your screen as the session proceeds. Also let you know that today's slides that we're sharing will be made available to all our audience members, along with our 2020 TSX 60 briefing in the coming days. And the materials will also be available for download from our website under the resources tab once they've been published. Finally, we'll be sending out a very short survey. I promise you, it's very short, only 3 questions after today's session, and we welcome your input into how we can improve or other topics that you'd like to see us talk about for future events. And with that, I'm going to hand you over to Kevin.
Perfect. Thank you so much, Michelle, and hello, everyone. Thank you for joining us today. I will be going through a brief overview of the results from our 2020 proxies, looking at the constituents of the TSX 60, and then pass the mic on to my colleagues to take a deeper look into the trends and considerations. As the data and findings will show, fiscal 2020 was really an unprecedented year in every aspect. The goals and objectives set at the beginning of the year needed to be adapted to the new realities. An important consideration before getting into the findings is to understand the performance context. On the slide here, we have the overall market performance as measured by the TSX 60 and TSX Composite, which saw a decline in Q1 and Q2 2020. It has since recovered to pre-COVID levels at the end of 2020 and has continued to rise throughout 2021. Equally as important is the divergence of the strong performance in the materials sector, as represented at the top in the dark gray line, and in stark contrast to the steep decline seen in the energy sector at the bottom of the graph in the light gray lines. And we'll unpack this a little bit further on the following slide. Taking a more granular look at the performance, the chart at the top highlights the returns of the TSX 60 constituents in 2020 versus the bottom chart, which shows the returns of the same set of constituents in 2019. Two key mentions on this slide include, and as noted on the previous page, there's a notable divide among companies in the resources sectors. Materials, which includes companies operating in the gold sector and represented in the yellow bars, typically saw positive returns in 2020, while those in the energy sector in the orange had negative returns who were hit by both declining oil prices and the broader impact of COVID-19. Additionally, a greater proportion of constituents had negative returns in 2020 compared to the previous year, as you can see down below, where a greater proportion of companies had positive returns. Now turning our attention to the compensation side of things. On this slide, we have shown median CEO compensation as measured by total direct compensation, or TDC. This includes base salary, annual bonus, and any equity grants. Overall, median compensation among TSX 60 CEOs remained flat in 2020 compared to 2019. This follows a 12% increase in median we saw in 2020. While not shown here, the variability of pay widened year over year, with the top quartile of payers increasing by 14%. Meanwhile, the bottom quartile decreased by about 4%. Taking a deeper look into the individual sectors, at the far right, you can see financials were the only sector that saw an increase in median pay. However, even though median pay increased, more than 60% of these companies saw year-over-year decreases in CEO compensation. At the other side of the spectrum, we can see that both materials and energy companies saw decreases in CEO pay of about 5% and 2% respectively. This was after significant increases seen in 2019, where pay increased by about 27% for energy companies and 22% for materials companies. Among those in the other category, there were significant one-time bonus awards to companies such as Canopy and Gildan, which drove up the year-over-year average. Taking a longer-term look at things, the group of bars on the far left and on this page highlight the CEO pay over the last 5 years. On the far left, we have the entire TSX 60, which shows a 4-year compounded annual growth rate of about 5%. In the next set of bars in the middle and on the far right, and for reference, we have shown the trend amongst the same constituents who have remained in the index over the last 5 years, and on the far right, those CEOs who have been in the role for 5 years or greater. Both of these follow a similar trend as the overall index on a year-over-year basis and are also at the highest level seen over the last 5 years. Taking a look at this slide and mindful that there is quite a bit of data to unpack here, what we have here is in the dotted lines, the target data for TSX 60 constituents, and in the solid bars, the actual compensation data. Focusing on the top, while total cash compensation was in line with actual cash compensation in 2019, we saw the opposite occur in 2020, where actual figures were less than target. This was driven by voluntary reductions in salaries and below target performance seen in annual short-term incentive programs. As we turn our attention to the chart at the bottom, when looking at overall pay as measured by total direct compensation, the below target cash compensation in 2020 was offset by the LTIP grants. This resulted in compensation that was slightly below target levels. And really to wrap things up on this slide, the key takeaway really reinforces much of what the media has commented on during this proxy season, as compensation forfeited via salaries represented a smaller portion of overall compensation. When we take a look at the entire set of executive pay as disclosed amongst the 5 of the highest paid executives, median pay has increased by approximately 4% in 2020. On average, CEO pay makes up about 40% of the total pay amongst the top 5 in the TSX 60, which is consistent with what we've seen in 2019. And with that wraps up our compensation section, and I'll comment a little bit now on our update on compensation design frameworks on the following pages. On this slide here, you'll see a summary of short-term incentive design. And in 2020, we did not see a significant change in average incentive design for TSX 60 companies. We continue to see a significant portion of incentive outcomes tied to financial performance, while ESG continues to grow. And as mentioned, our dedicated webinar at the end of June will go into more details around ESG in incentive plan design. One notable area to highlight here is that when it came time to determine 2020 payouts, almost half of the constituents in the TSX 60 applied some level of discretion. This was almost 3 times the levels we saw in 2019, and John will provide a bit more detail during the next section of our webinar. Turning our attention to long-term incentives, stock options continues to see a decline in prevalence and weighting within the overall long-term incentives with companies such as BCE and Manulife announcing their intention to remove stock options from their long-term incentive plan in 2021. The changes were likely a result of the upcoming stock option taxation changes, and John will touch on this a little bit further during his section. Finally, in our last section, we'll give a quick update on Canadian say-out pay results for 2021. On this page here, you can see the 2021 proxy season saw a decrease in say-out pay results with an increase in the proportion of companies that received less than 90% support, with some notable names highlighted here, including a few with failing or below 50% approval on the far right. Turning our attention into a more granular look, while overall say-on pay did decrease, the results by industry are varied, with the energy sector as the only one posting a modest increase from about 88.7% to about 89.5%, whereas the other sectors saw decreases. And with that, one last point I want to make here is that our guest speaker, Blair Jones, will provide some insights on the US proxy season and especially the say-on pay results seen south of the border. And with that, I'll hand it over to John, who will kick off our next topic on COVID-19 observations and other notable trends. John?
Thanks, Kevin, and good afternoon, everybody. I'll now be providing some high-level observations related to COVID-19 actions on executive pay in Canada and touch on a few other emerging topics. As we all know, the impacts of COVID-19 pandemic were wide-reaching, as were the experiences of companies across Canada. We conducted director pay pulse surveys in August and November of 2020 and observed that a vast majority of respondent companies were either slightly or significantly impacted by the pandemic from a financial perspective, particularly those in the hospitality and energy sectors. Meanwhile, a minority did benefit, grocery retail and many technology companies, for example. What made the situation so challenging was the lack of historical guides for how to proceed. The existential nature of the crisis was distinct from the financial meltdown some 10 years ago. From a compensation and incentives perspective, companies needed to strike a fine balance between continuing to retain and incentivize key talent while applying prudent yet flexible decision-making that addressed a variety of stakeholder considerations. Many companies, particularly those hardest hit, took quick action to cut executive salaries and board fees. Outside of these actions, most took a wait-and-see approach as it related to incentives, opting not to tinker to STIP or LTIP plans mid-year, but rather wait to apply informed discretion and make adjustments at year-end, when a full view of annual performance was available. Through our client work and this TSX 60 review, we observed a generally measured approach when assessing annual performance for annual bonus and PSU payout purposes. Some themes included, first, the inherent challenge of balancing a negative shareholder experience and poor financial results with distinguished management contributions and efforts in response to the crisis. Second, adjustments made to financial metrics to remove the negative, or in some cases, positive impacts that can be directly attributable to the pandemic. For example, the closure of manufacturing operations. There was a significant increase in the use of board discretion in this respect, as Kevin mentioned. And third, the principle of equitable treatment across the organization from an incentives perspective. This included more liberal application of upward discretion in annual bonus payments for the broader employee population versus executives. This is partially rationalized by the strong rebound in equity incentive values by the end of 2020 for many companies. Now, the reactions. As many tuning in would have seen, several large Canadian issuers have grabbed headlines in recent months due to their executive compensation approach disclosed after the pandemic. Shareholders and proxy advisors have also been vocal in their displeasure in several cases, as Kevin touched on. While pay and performance disconnects were the leading cause, as they usually are, there was an added layer of social disapproval that caught hold this year, spurred by the use of one-time awards and questionable application of upward bonus discretion in some cases. Air Canada and NAV Canada have been the most recent examples where executive pay decisions did not align necessarily with the broader stakeholder expectations, with the public and political uproar in Air Canada's case, having their executives return the special compensation they received. Now, switching to 2021 executive pay decisions, few companies opted for major overhauls to their incentive plans, instead making tweaks around the edges to reflect the continued uncertainty about how performance will unfold this year. A primary challenge facing compensation committees and management teams continues to be setting annual and multi-year financial targets. While target setting and calibration decisions were being made in early 2021 for many companies, it was still less than clear how quickly performance would revert back to normal conditions. Companies worked to adapt their incentive plans to the uncertain times, forecasting the rebound as best they could and applying general principles around consistent performance measurement. Some of the design changes we saw applied to 2021 and potentially future years included, first, the widening of performance shoulders for performance metrics in the annual bonus and PSU plans. This involves adjusting the steepness of payout curves to increase the landing zone where a payout would occur. Flattening the curve has the effect of requiring higher performance to max out, but the plan is more forgiving on the downside. The curve can be flattened even further around target performance, where forecasting can be most difficult. Second, the increased use of and weighting towards non-financial measures in annual bonus programs, as well as the application of a formal discretionary component. Non-financial metrics in the strategic or individual buckets or the formal discretionary component can stabilize the program and give compensation committees greater flexibility in assessing results at year-end to reflect a more holistic view of company performance. Such changes, however, must be continued to have sufficient line of sight for the participants and will require more thoughtful disclosure, as was the case this past year. Lastly, as it relates to PSUs specifically, some changes included the increased use of relative performance metrics that do not require internal financial forecasts, relative TSR, for example, the measurement of one-year performance periods in addition to the three-year typical performance period for PSUs, what we call the umbrella approach. This has the effect of further stabilizing PSU payouts. And finally, in some cases, delaying the setting of financial targets altogether. This could take the form of setting goals for years 2 and 3 of a 3-year period at the end of this year, when there is more comfort in the company's ability to forecast targets. Overall, the impacts of COVID-19 created an abnormally challenging dynamic when assessing year-end performance. In many cases, compensation committees had to weigh the relative significance of poor financial performance outcomes with management, retention, and incentivization considerations. In 2020 and beyond, as economic and financial prospects recover and shareholder feedback is incorporated, companies should be in a better position to make program design adjustments that will support prudent compensation decision-making at year-end. I'll now touch on 3 other emerging topics that have received significant airtime through the 2021 proxy season in Canada. First, the upcoming changes to stock option taxation. Second, the seemingly accelerating focus on ESG-related topics and their accompanying incentive implications. And third, what the flurry of recent IPO activity in Canada means from a talent and retention perspective. So first, on stock option taxation, the long anticipated changes to Canadian option taxation rules are set to be effective in a few weeks, July 1st, 2021, applying to non-Canadian controlled private companies with revenues in excess of $500 million. Sorry, $500 million. So effectively the largest publicly traded companies in Canada. All stock options granted by these companies above $200,000 will now be taxed at marginal tax rates, akin to that tax rate for RSUs and PSUs, other equity instruments. The company will then receive a corresponding tax-deductible expense equal to the in-the-money benefit when those options are exercised. The impending changes mark an opportune time for companies to review their LTIP design approaches. And please visit our website where we have parts 1 and 2 in a 3-part series of briefings on these changes and their incentive design implications in our Thought Capital section. Next, we have the continuously evolving arena of ESG. While the governance component of ESG has become table stakes for Canadian boards for some time now. The topic of E&S, which includes sustainability and diversity and inclusion, is growing in importance within boardrooms and beginning to cross over into incentive design discussions at more and more companies. A well-executed E&S policy has, from numerous studies, shown to drive long-term investment outperformance, stronger earnings, and lower operational costs. The impacts of the COVID-19 pandemic and recent social unrest have undoubtedly accelerated many of these discussions, requiring companies to respond to a broader set of stakeholder considerations related to sustainability, social issues, and other human capital topics. We believe linking E&S strategies to executive incentives is a key step to support real progress in this area and is increasingly drawing the attention of institutional and activist shareholders alike. Companies across North America have adopted a wide variety of approaches when beginning to link ESG priorities to their incentive programs, with many taking a principled, step-by-step approach that aligns with the stage of their overall ESG strategy. The last item I'll briefly touch on is the recent flurry of IPO activity, with dozens of Canadian companies taking advantage of favorable market conditions to go public this year or in the process of going public. We see this IPO activity from a compensation perspective as a prime opportunity to enhance governance and incentive frameworks for public consumption from day one. This includes implementing more progressive pay governance practices, such as share ownership guidelines and clawback policies, as well as thoughtful approaches to short-term and long-term incentive design. This activity also has broader human capital implications, we believe, as the newfound access to publicly traded equity offers a flexible currency for talent attraction and retention needs, and will likely have the impact of further spurring competition for talent in high-growth sectors in Canada. I'll now pass it over to Blair for an overview of US pay trends.
Thank you, John, and thank you to my Hugessen colleagues for including me in this discussion today. What I'd hoped to do was to echo some of what Kevin and John covered and give a US lens to it, and then maybe add a couple of other topics on top of that. So first, we'll talk about the COVID trends that John just covered. And when we look at a subset of the S&P 500 that has reported to date, so about 345 companies had reported as of June 8th, 40% of companies ended up making some sort of change to their incentive plans due to COVID. The majority of that was in the annual incentive plan. Now, interestingly, as you look at companies across the US, they were clearly affected differently. There were companies that got tailwinds, and those were companies in the tech industry and the consumer products universe, grocers, some of the essential retailers did fine, and some of those didn't have to make changes at all. In fact, some of the things they were facing was looking at record high payouts and trying to determine what the fair sharing of an unusual time was with the broader population and all stakeholders. And there were others who experienced severe headwinds, so those in the retail sector, hospitality sector, and a number of the manufacturing sectors throughout the US. And they were the ones who had to take these kinds of actions and adjustments. Now, part of the reason that we saw more action and activity on the annual incentive front is long-term incentives are by their definition long-term, and there is some sense that some of the performance issues could work out over the long term. However, there was also strong guidance from both the proxy advisors and institutions that they were less open to changes to long-term plans, even if they were affected across 3 cycles. So companies, by and large, stayed within the bounds of annual incentive changes, although not completely. What I thought we would do next is maybe take a deeper dive into 2 specific industries that were affected by the pandemic, who did have headwinds that they faced, to give a little bit more texture behind what was happening. So this first deep dive is into 61 non-essential retailers. And if you look across the different actions that were taken, the dark blue are the annual incentive actions and the light blue are the long-term incentive actions. Again, many of these changes echo what John was talking about, the most significant action taken was applying discretion. And that turned out to be the wisest course for a number of companies because they were setting goals or would have had to set goals in the midst of some of the darkest times of the pandemic. So being able to go through the year and look in the rearview mirror ended up being an advantage. So companies typically applied scorecards that took into account their relative performance versus peers, took into account the strategic actions that they took into account what John said about how well they managed through the pandemic, and also some ESG actions as well. Most of those companies ended up paying out something under 100%, somewhere between 50 and 100% overall. But there were a number of other actions taken as you look across the bars here. A number of companies did actually reset goals because many retailers have fiscal year ends that end in January. They were able to reset their goals or actually set goals taking into account some of the troubled waters they were heading into. They would have normally set their goals in the April or May time period, and they were able to do that at a lower level. With that, a number of them knew that their results for the year would be lower than in previous years, so they did hand in hand reduce the target or the maximum payout opportunity to something like 125%, for instance. We did see a number of these companies modifying performance periods, so instead of doing a year's measurement, they took 2 6-month periods so that they had the chance to continue to evolve their goals to the environment they were seeing. And some just delayed goal setting altogether. We did see some activity again on the long-term incentive front, but again, it was muted relative to the activity on the long-term incentive front. The kinds of things we saw were some special grants. We also saw people just waiting to make their grant until the fall. We saw a number of companies switch to relative measurement, primarily relative TSR. And then the other thing that we saw that's not captured on this page is a change in the LTI mix, where companies that might have had a 70-30 performance share to restricted stock mix or a 60-40 mix changed to a 50-50 type of mix. If we go to the next slide, we saw similar trends in the automotive industry as well, where the majority of companies who took action to apply discretion to their annual incentive plans. A few did modify their outstanding awards or their performance periods for their long-term plans or reset goals, but by and large, applying discretion. If we continue to move forward, I think what's instructive about this time and looking at these examples is some of what John got into is, what do we think the lasting impacts will be? So at least for the next year, we're going to continue to see companies who may be setting seasonal goals for their annual plans. We see that particularly in some of the hospitality sectors, in the airline industry and retail, where companies are still trying to get their footing. Going into this year, not everybody was vaccinated, but knowing the back half of the year could be very different. We'll probably see that carry through, certainly 2021 when we look back on this proxy season, or we'll see perhaps a few companies still carrying it into 2022, as a number of these industries are not expecting to be back to normal until 2023. The kind of silver lining in all of this, as both Kevin and John alluded to, is it gave us the opportunity to look at some new metrics. And companies introduced a variety of non-financial metrics and ESG metrics that allowed a fuller assessment of performance across the board. And many of those are sticking. I think companies found that it was helpful to look not only at the outcomes of financial performance, but at some of the inputs as well. So this was an unexpected opportunity to try out some of those metrics, but they did prove helpful in many regards. So stay tuned on that, and particularly for the next webinar that will go deeper, particularly into the ESG metrics. John had mentioned that people widen the shoulders on their incentive plans. I think as long as we're in this period of volatility, we'll probably see that carrying on into 2022 as companies try to regain some predictability to their performance. The wider performance curves allows a softer landing on the downside, but also no windfalls on the upside for volatile performance. We also will continue to see some governors on the maximums as companies are still performing below 2019 levels. I think one of the more interesting things about this period was that companies have recovered faster than was thought, and actually stock prices have recovered even faster than that. So it's created some dynamics and interesting discussions in the boardroom as to what's right on that front. We will continue to see some rebalancing of LTI, particularly for those companies who really thought they were on the side of the angels in terms of having a more performance-based mix. The challenge they ran into was when the pandemic hit, that mix was overly punitive. So I think companies will be trying to figure out what performance-based mix makes sense. We will see, as we look at the proxies in 2022, that a number of companies may not have taken action in 2020, or maybe they took some action in 2020, but they also enhanced their 2021 LTI. And this was in part because the proxy advisors had given such strong guidance to not change outstanding cycles. People and companies invested in the go forward and how well we actually recover from this pandemic. So we will see some 2021 increases in award sizes, and including those companies that may have made special awards in lieu of unearned awards in the past. Those awards may show up depending on when they were granted in the 2021 performance year and the 2022 proxies. I think we've also gotten to the point, as we get to the bottom row here, that discretion is no longer a dirty word. I think that investors learned that boards can use discretion effectively and thoughtfully. So I would expect, particularly as it relates to the next few years, that we'll see more discretion and more looking in the rearview mirror, taking into account a scorecard of different factors. And that's just a good exercise for committees regardless as they look back on a year. Again, we'll see a lot of attention to all stakeholders and a high premium on explaining what you did and the actions you took relative to pay in your proxies. Those companies who made changes and did well in this year's Say on Pay were very, very benefited by good disclosure and good rationale. And those that didn't have good rationale, unfortunately, were penalized with against recommendations or lower Say on Pay votes. So maybe then we can go forward and talk a little bit about Say on Pay and how that played out in the US. So here are the results from our latest Say on Pay result. And for US companies, our Say on Pay failure rate is 2.9%, which is higher than it has been in past years. There are 48 failures in total, 16 of which are in the S&P 500. Now, only 14 of those are related to COVID actions. So the remainder have to do with some call out from the proxy advisors related to pay and performance alignment or pay practices as in the past. Although there were some interesting trends and nuggets in some of the failures this year that we'll talk about in just a minute. One of the things that did stand out to us is the current average vote result of 98.8% for the Russell 3000 is higher than the average vote result for the S&P 500, which is running at 88.6%. I think I caught your frog in the throat, Michelle. So the S&P 500 vote results on average are below those for the Russell 3000. And the spread between the two is higher than we saw at this point last year. Interestingly, I think Kevin had highlighted that the energy companies actually were the ones that recovered on Say on Pay. They actually have had the most failures in our US market. When you look at the pink, these are the below 50% slice of the pie. So the energy sector has actually fared the worst among our different industries that we look at. And let's go to the next page and dig a little bit beneath some of these findings. As I mentioned, one of the things that has been interesting as we looked at the results is the number of high-profile failures and the higher failure rate in the S&P 500. So and that's all fueled by the higher rate of against recommendations. These are not all failing companies, but companies that received against recommendations from ISS. The other interesting trend as you look below, beneath the surface is we do still see a high number of companies passing SANPay with a high rate of 90% or above. But when we look at some of the other distribution in between at the 70 to 90%, and particularly at the 50 to 70% returns, those are much lower than in prior years. So you've got this outcome of you either pass very well or you fail very poorly. And it's an interesting barbell kind of outcome relative to prior years. So if we go to the next page, here are some of the themes that we're pulling out from this SANPay season. You know, one, as I've now mentioned several times, is the spotlight on the large cap companies, that the focus on the larger cap companies where they represent a third of the failures is different. It's a trend that had started in prior years, but seems to be more pronounced in this year. The second group of challenges is just that some of the votes, in addition to being about pay for performance alignment and pay practices, as we've seen in past years, are also more principled kinds of votes, where we see, for instance, among the companies involved in the opioid litigation, new challenges with excluding litigation expenses for large litigations. And we think that this litigation cases, we think that this trend, while it's focused right now on the opioid, the companies involved in the opioid litigation, has broader impact for any company that has large litigation outstanding, with the idea that it will create a conversation as to how to handle those expenses, because it's been typical across companies to exclude those because your litigation strategy operates separately from your compensation strategy. Often the individuals involved at the time of the case that the litigation is covering are no longer with the company, and the litigation expenses negate the underlying operational performance. So it has been accepted practice to exclude those. And this is a new conversation out there today that investors are clearly weighing in on. The other type of principled decision is special awards are getting panned. And this is, again, not a new trend, but it does seem to be a more pronounced trend this year, where special awards, particularly time-based special awards to non-CEO NEOs, attracted a lot of attention. And then the last two things I wanted to cover is that we do think that we're not done with all of the effect of COVID and its effect on SANPay. This year, we do think it will carry over into the next proxy season because, as I mentioned, some companies made grants in 2021 or took actions that won't show up until the 2021 performance year is done. And so there'll be some carryover in those decisions. And then finally, you know, we've all been talking about ESG, but this was the year of ESG for shareholder proposals, and they're getting an elevated level of support, above 70% in many cases, on a variety of different topics. So this issue will continue to move forward. If we go to the next page, the last theme emerging, and this will be something that you'll talk more about in your next webinar, is the entrance of ESG metrics into incentives. So as John said, there's good data that shows the importance of ESG and its effect on companies' long-term sustainability. And now the Holy Grail is trying to figure out whether some of those ESG metrics belong in incentives. So this slide just shows the prevalence for both the for all of the S&P 500, but the top 200 and the bottom 300 within the S&P 500, and the types of measures that they're using. I think the most interesting is that diversity and inclusion coming out of the social justice movement of the last year, we're seeing big changes in that front. You're seeing 38% of the top 200 having some measure of diversity and inclusion, and 62% of the largest companies having some ESG measure overall. I think as we go forward, our questions are, how are these measures going to change? Because some of the measures are traditional measures, like safety was clearly a big measure this year in the midst of COVID. But will these measures change to more of the sustainability type measures that are being talked about and move away from some of the more operational metrics that have existed in the past? If we go to the next slide, the last thing that I thought I would cover is just an area of interest for many US companies is what's happening in the tech industry. And the reason this has become important is it's the very rare company now that isn't tech enabled. And even traditional companies are finding themselves having to think about the trends in the tech sector as they think about the high demand, high value talent that they have who help with software and AI types of application. So as we look across the tech sector, even in the midst of COVID, pay levels for high growth tech companies has been exploding. And if it's felt in the tech sector, it's felt in those industries that are needing to bring in those talents to be more tech enabled. We're seeing the IPO and SPAC market, as John alluded to, creating all sorts of implications, and particularly this interest in these moonshot awards that are large awards with high performance hurdles related to market cap, but changing the dynamic around how do you create urgency and how do you galvanize an executive team? We're not seeing those kind of awards necessarily translate to industries outside of tech, but it is creating a dynamic and an expectation even below the levels of the NEOs as to what fair levels of pay are. We're seeing a lot more special awards and a shift away from performance-based equity to time-based equity, and equity that vests almost immediately. So all of the common wisdom for most companies really is in a different place for tech. And as we go forward, we continue to look at the FANG stocks, Google, Facebook, Apple, and the others who have a high impact on the talent market because they're everywhere. While the IPOs, like Airbnb and DoorDash have gotten much of the attention recently and generated a lot of the excitement, these bellwethers do have a lot of influence on the talent market and are important to watch. And then the final piece is this increased shareholder activism that we've seen among all of these companies, as they have given employees stock as the important currency of choice, and these employees want to have a voice with the shares that they hold. So the technology industry is definitely one to watch, and definitely one to look for what trends may continue in the future. So again, I thank you for having me today, and Michelle, I'll turn it back over to you.
So some new trends and some new directions on executive comp and below, absolutely. A lot to digest there. I'm very thankful that we are recording this and that the slides will go out to all of our audience and spend some time with the content and the data. So thank you for those great insights, Kevin, John, and Blair. Also appreciate that you are able to work in some of the responses to questions from our audience already, so that is appreciated. So let's keep it going. First, call out to our audience. If you have any questions, please feel free to submit them in the live Q&A section. For those of you who haven't found it, in the top toolbar, you will have, I think it's an air quotes, sort of air thought bubble icon with a little question mark within it. So please feel free to submit any new questions there. With that, I'm just going to sort of start at the top end of it. The first one's a bit of a technical one. So I think in all honesty, we have been talking about the Canadian federal government's tax changes on stock options for at least 2, if not 3 or 4 years at this point in time. Now seems like the day really is here for this piece. And it's a complicated piece of legislation out there, no doubt. John, you specifically mentioned sort of a number of things. You pointed the audience to some resources. But you also called out that it can be a good time for companies to review, reconsider their approach to long-term incentives. But you didn't get into any specifics. Just wondering if you can share some insights or sort of what we're seeing, how companies might be thinking about changes to their long-term incentive program.
Absolutely, Michelle. So while we don't expect most companies to completely drop the use of stock options altogether, though we did observe a couple high-profile companies actually do that this past year in Canada, many will be undertaking detailed reviews on the implications of the changes. So that means the relative pros and cons of the various LTIP instruments, being outside of stock options, RSUs, PSUs, and then there's other longer term treasury settled instruments that companies can actually take maybe now a critical look at to see if there are benefits from using those types of instruments, which more so replicate the longer term nature of stock options that have terms of 5, 7, 10 years, whereby RSUs and PSUs, most of those in Canada are constrained by that 3-year time vesting condition from a tax perspective. So companies will be undertaking these types of comparative analyses under different share price scenarios to see what the implications really are. Clearly, a higher degree of share price performance will be needed to replicate the same after-tax value after these rules are put in place. However, we believe many companies will still come to the conclusion that stock options will continue to have high leverage, higher payout potential than some other instruments, and remain a very viable LTIP instrument for higher growth oriented companies, though potentially at a more modest degree in the LTIP mix going forward.
Great, thanks, John. Blair, this next question goes to you, and it's effectively recognizing the impact of the proxy advisors, particularly at the S&P 500 companies where you get a lot of headlines, a lot of media attention in this past year. Any updates on how the regulators are thinking about rules governing the proxy advisors in the US?
Yeah, it's a good question. And there is actually recent news on this front. I mean, there's always, to your point, been a healthy tension between the institutions who want good advice and information from the proxy advisors who help their voting process, and the issuers who want to make sure that they get the best review and the most fair review. And 2 years ago, and then with amendments last year, the SEC had put out rules to further regulate the proxy advisors and to try to eliminate some of the conflicts of interest that existed. While the rules didn't go as far as some issuers had hoped, the hope was that the rules would raise the bar on the proxy advisors and make them somewhat more accountable to share the different interactions that they had, as well as allow for more points of view from the issuers to come through, so everything was in one place. The SEC in the US has recently said that it will not actually now enforce those regulations, and may actually take the action to remove them altogether. So we're a little bit in limbo right now, and there's some speculation that this issue may be one that becomes more political rather than regulatory oriented, at least in the near term. So I think everybody will be operating as they were, and we hope that everybody operates at the most professional standards that they can.
We can hope. This next question is sort of goes back to, Blair, your slide about the lasting impacts and implications from the 2021 proxy season. It talked about, one of the boxes talked about the ability to explain actions transparently and credibly. And in all honesty, responses north and south of the border may differ for this question. So maybe I'll let you kick it off and then sort of hand it over to either John or Kevin to sort of provide the Canadian context. But the question is here, any thoughts on sort of whether we'll see this enhanced transparency and accountability flow through either in enhanced disclosure, so the proxy disclosure, versus direct engagement sort of with the shareholders, or is it a bit of a combination of both? Any thoughts on that?
I think it is a combination of both because particularly as you think about the decisions and voting that these big institutions make and the proxy advisors have to make, it's difficult for them to make to make some of their votes without having seen some of the actions in a filed document. So your engagement becomes your opportunity to grease the skids a little bit and heighten awareness that some of these things happened. And you can, in your engagement, file a document. So you start by having some of your information filed out there. But your proxy season becomes your ability to bring it home and bring it all together. And it is interesting because, when I was first growing up with disclosures, the idea was less is more because more invites more questions. But it does feel like, at least south of the border, that right now more is more. And as you look at the institutions and you look at the proxy advisors, they're asking and hungry for the rationale. So the more you can tell them, particularly if you have a good story, and most companies do, the more they're inclined to at least listen to you and hopefully give you the benefit of the doubt.
Yeah, what I would add to that is very similar observations here in Canada. I think from more kind of a public perspective, some of the recent press around maybe in some cases where there was a lack of forethought or disclosure around pay disclosure is just going to put that much more pressure next time around to be even more transparent in the disclosure and thoughtful in the decision making. So I think we can expect that just to progress as we move forward, and likely beyond the onus on the companies to do so more so than from a regulatory perspective up here in Canada.
So we all should be on the lookout for an 80-page proxy from. Hopefully we won't land there. We'll sort of have companies drafting clear, concise messaging on their compensation decisions. This next question, it actually looks at sort of the impact of COVID and sort of on the flip side, those companies that were positively impacted. So the question, maybe Kevin, to you first, and Blair, if you'd like to chime in as well. Any color or sort of other context that you can provide, sort of examples in terms of the adjustments that were made for some of the companies that experienced the windfalls coming out of a COVID year?
Yeah, for sure. I can take this one. So definitely mixed practice, and you can see both sides of the argument. One side being those that experienced windfalls and decided it was really outside of management and the company's control and decided to hone back the actual payouts, whereas the other side of the coin being companies that just let their incentive plans run as if it was just a regular year and payouts followed whatever formulaic outcomes were provided. The other aspect being looking at compensation as a whole, and not only the sort of annual bonus and the windfall seen there, but also the share price appreciation, but also, depending on where the company landed at the end of the year, whether the share price was down relatively at the same level or seeing a significant increase, that also played into these decisions that committees and boards were making. But overall, there was really, two sides of the coin and not a clear line on what the rules were.
Yeah, and I'm glad to weigh in of what I saw in the U.S. So I think Kevin did a good job of providing a pretty good summary of the trade-offs. And I would say the majority of companies did just let their incentives run. There was more speculation at the beginning of the year that there might be some pullback, but the companies that did pull back were pulling back, looking at actually a similar scorecard that the companies who had headwinds were looking at for discretion. So you might have done a negative discretion if your relative performance actually was poor. So even though you did well on an absolute level, you lagged your peers. You might have done it. Actually, one of the largest reasons that companies did it is if the experience for their employees had been really tough. they didn't feel like it felt right to pay executives out at maximum while their employees had to bear a lot of the burden. So some companies adjusted for that as well, but many were just going through the scorecard of what did we accomplish over the course of the year, and particularly how did we perform on a relative basis.
Excellent. This next question is not directly related to executive compensation pay programs, but it was something that came up in the sense that we are seeing increased levels of IPO activity, both north and south of the border. And so the question, maybe to you, Blair, and then John, if you'd like to weigh in as well. There is increasing pressure on public companies to fulfill the social objective side of things, and just wondering whether or not we're seeing any companies look to go from the public realm into the private realm, where you can sort of quote unquote choose your own shareholders. It's harder, whether you can fully choose your own shareholders, but just sort of any reaction there, just given the uptick in the IPO activity. On the flip side, how you might see something there.
Yeah, to be honest, there always is discussion about whether it's worth it to be a public company, but in this environment, I've heard less of it perhaps than I've heard in prior years. It does seem like the public companies that we're working with are embracing this whole idea of stakeholder capitalism, and actually in some ways getting very energized by the possibilities that it has and the branding that it provides for them. So I think companies are struggling with the measurement, and they're really hopeful that there will be a common set of expectations and metrics put out by the institutions versus either having to come up with your own or choose among the different standards that exist today. But they, by and large, while it's hard, it's expensive. Like I said, this is a period where I feel like there's been less of that discussion about going private than in past years, and it's very interesting. And I do think this new stakeholder capitalism is actually giving companies a new way to think about who they are.
And I think the recent IPO activity in Canada is kind of a clear observation that the flip side of that gives companies the opportunity, when they do go public, to create a very solid foundation of the governance practices, and especially those companies in more ESG related sectors, and the investors that they're trying to attract in their going public process. I think that should hopefully spur some of those other companies to make those same adjustments and not use compensation as a reason to go private.
I think we've got, looking at the time here, maybe we can squeeze one final question in. It's on the topic of special one-time awards. Obviously, we've seen the proxy advisors very critical of these. They do flag them and sort of call them out. Just wondering, in terms of what we're seeing in the tech industry in particular, just the high levels of competitive pay and just as a competition for talent there. Retention, it's a reality that companies are struggling with. Any thoughts on how to approach some of those concerns, whether it is with the one-time awards and how to make them potentially a bit more digestible for the shareholders, even if not for the proxy advisors? I'll leave that open to if anyone wants to touch it.
So, I can start. I think that it's become clear, at least if you have NEO awards, that the better path is to try to have some sort of performance. So I know my clients who have been providing special awards have been trying to link to the objectives that particular executive has underway. Deeper down in the organization, of course, there are fewer restrictions to giving special awards. I think the challenge that companies are finding, however, is that with the tech market changing, and with people able to jump and get vesting right away, which is a brand new phenomenon, some of those retention awards have less hold than they did before. They could always be bought out, but part of the appeal was they're already vesting, and if you move, you're going to have to wait for your vesting to happen, and that gap is going away. So I think, pay is an important part of the equation, and certainly being able to touch people multiple times seems to be important in the in the tech cycle, so they get an annual award, but you have other times of the year you can touch them, and top-ups you can do to keep their overall wealth potential growing if their high potential becomes really important. But a lot of it is not about pay, and it's about the opportunities you create for them and the job structures.
That effectively takes us to the end of our time, so I'm sort of going to stop Kevin or John for sort of chiming in. I think what you've mentioned there, Blair, really does apply also across to north of the border, what we're seeing here. To our audience, if we didn't get to your questions, apologies, but please don't hesitate to reach out to any of our consultants. Always happy to connect and answer those questions. And then one final request, you will be receiving a short survey for today's session. Please, it would help us to sort of think through the content for any sort of future webinars that we're doing. So please fill that out. And if you haven't already, please register for the ESG webinar on June 29th. And I want to thank you all for attending, for your time, and particularly over lunch hour for anyone in sort of Eastern time zone. And last but certainly not least, thank you to Blair, John, and Kevin, all of our panelists, for their time and their preparation, sharing their insights today with us. Have a great day and be well.